Good morning. It's Friday. Welcome to another 5 with Fitz. It's game on time. There's a lot going on today, so I thought we'd just dive in. It might be a little longer than usual, but thanks as always for spending a few minutes of your valuable time with me. Buy the best, ignore the rest. That's where we are today. So here's my playbook. Number one, would I put new money to work now? And if so, where? Well, the super savvy Maria Bartiromo kindly asked me back to her show this morning for discussion about several key topics on the minds of many, including those things, but oil, data centers, AI, and more. Perhaps most importantly, again, where would I put money to work now if I would put money to work? I think the answers might surprise you. Maybe they won't. I don't know, but you can watch that video elsewhere on my channel. And on a related note, don't even get me remotely started when it comes to all-time highs, stocks are expensive, or valuations. I mean, people grouse about those things all the time, but they shouldn't because the data presents a very different picture. In fact, all-time highs are the signal that many investors probably are ignoring to their detriment. There's a chart in the written version of the 5 with Fitz I want you to take a look at if you're one of them or if you're part of the spreadsheet gang and those things are ringing through your mind. Number two, the most doubted company in tech just did it again. Now, don't get me wrong. I respect the bears and the naysayers tremendously because they repeatedly highlight risks. Apple is behind on AI. It's lost the narrative. iPhone sales have plateaued. Devices have become commoditized. Yada, 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 yada. Yet, in one of the greatest truisms ever, investors who have stayed the course, stayed objective, and followed Apple's journeys have consistently been rewarded. Case in point, over the past decade, Apple has achieved an annualized return of roughly 28 to 29% per year with dividends reinvested compared to the S&P 500's average of 12 to 13% per year. That is more than double the index annually, folks, for 10 years running. Now, if you're keeping score, and I hope you are, that means the 10-year total return for Apple is approximately 1,160 some odd percent, meaning that a $10,000 investment a decade ago would be worth nearly $126,000 today. Not bad, huh? The S&P 500 over the same time frame delivered strong but far more modest gains of around 41,000, so roughly 1/3 of what Apple served up. Let that marinate for a moment. The bears have been wrong loudly and repeatedly the entire time. Once again, investing in optimism beats cowering and pessimism. And Cupertino just proved the doubters wrong yet again. Again. Revenue in the latest earnings report came in at $111.2 billion, up 16.6% year over year. EPS came in at 201, up from 165 in the same quarter last year. Gross margins hit 49.43%, up from 47% a year ago. Nearly half of every dollar it takes in goes straight to the bottom line. Let that sink in, people. Nearly half of every dollar that company sells in any product, any service, anywhere in the world goes directly to the bottom line. And if you're an investor, guess what? That benefits you. Finally, Apple, speaking of which, authorized an additional $100 billion in share repurchases, and it raised its dividend to 27 cents a share. I love that part because it means I get paid to be an owner for the risks I take as an owner. Now, it raised guidance as well. So where does Apple go from here? I mean, that's really the question. I've got a few ideas, and we'll be talking about this for a long time to come. But the thing you want to think about is this. Apple is now the only big tech going hardware first. Everybody else is going software first. An investing tip in this department, when an industry leader like Apple takes a very different path, very deliberately, my experience is you want to pay attention because it means that their leadership sees something the way the rest of the world doesn't. Apple has a long, distinguished, and profitable history of doing things its own way. Exactly. All right, number three, the FDA said no, the analyst said nah, and I'm saying I'm going to watch closely. An FDA advisory panel voted 6-3 Thursday against approving AstraZeneca's oral breast cancer drug camizestrant, if I pronounced that correctly, a targeted therapy that was aimed at a specific type of hormone-sensitive tumor. Boy, that stuff's a mouthful. But it's serious. And the panel's beef? Well, the trial design. They weren't convinced the data proved that switching patients to camizestrant early actually improve long-term survival compared to existing treatments. Now, that's a fair concern, right? The FDA wants to see that a new drug is meaningfully better, not just different. And the FDA doesn't have to follow its advisory panels, but it usually does. Anyway, you can guess what happened. AstraZeneca's London-listed shares dropped about 2% on the news. But here's what I find interesting, though. Analysts aren't throwing in the towel. AstraZeneca still has a credible path to $80 billion in sales by 2030 across its broader portfolio. Oncology, we've talked about many times, is a massive and growing piece of that story. And camizestrant, boy, that's tough to pronounce, isn't the only card in the deck, right? Now, I'd call the $80 billion target a definite maybe, with emphasis on the maybe. My POV is that one advisory panel vote doesn't make or break a company like AstraZeneca. What it does do, though, is remind us that drug development is a long game full of setbacks, redesigns, and second attempts. The companies that win in pharma over time aren't the ones that never stumble. They're the ones that know how to get up, redesign the trial, and come back with better data. Now, my 2 cents on AstraZeneca is that it's a legitimate global pharma player with a deep pipeline. A 2% haircut on a panel vote isn't reason to run. So if you own it, it's noise. If you don't, however, this isn't the catalyst that I'd need to start a position. Personally, I'd want to see more clarity on the camizestrant path forward and how management responds. But that's just me. Keith's investing tip in this department: quality matters more than short-term votes. One no doesn't mean never, it just usually means not yet. All right, number 4 today. Hertz plus Uber equals, really, let me explain. I don't even know where to start with this one, really. Hertz, yes, that Hertz, the one that went bankrupt in 2020, is now partnering with Uber to power autonomous robo-taxi fleets and driver-led rideshare operations through, boy, here we go, a newly launched unit called Oro Mobility. Now, apparently, they're going to handle the unglamorous but necessary stuff like maintenance, charging, cleaning, and logistics for Uber's autonomous vehicles. Now, the robo-taxi service is going to use Lucid vehicles equipped with Neuro self-driving technology, launching in the San Francisco Bay Area later this year with expansion in 2027. You got all that? Good for them, I suppose, really. Points for the hustle, definitely. But here's what I can't get past. Call me crazy, and plenty of people will, undoubtedly, but Hertz dumped its entire Tesla fleet in 2024 and could have had a front row seat to the autonomous future they're now scrambling to buy their way back into with Lucid and Neuro. Instead, they sold off roughly 20,000 Teslas at a loss, citing high repair costs, and called it good management. I don't think so. Anyway, now they're chasing the same trend with different hardware and a partner who has its own set of complications, and they want you to believe it's the greatest thing since canned beer? Really? Doesn't make sense to me. The autonomous vehicle story isn't new. The opportunity was right in front of Hertz the entire time, and they blinked. And now they're trying to reconstruct it at a higher cost with more complexity. Hertz remains a show-me story, in my humble opinion, with a complicated balance sheet and a history of decisions that make you wince, right? In my humble opinion, the real play here isn't Hertz. It's understanding which companies in the autonomous vehicle supply chain actually have durable, competitive advantages. Now, Neuro is interesting. The charging the fleet logistics structure underneath all this is interesting. But picks and shovels are always more profitable than gold rushers, right? And boy, we've talked about this a lot. So an investing tip in this department: the most expensive words in investing aren't "this time it's different." They're "we changed our minds." And Hertz, you change your mind. All right, and number 5, calling all OBAers. It is Issue Friday. If you're already a part of the OBA family, you know what this means, so please keep an eye on your inbox later today. If not, please indulge me and let me explain. There's a lot of people reading along today that are just figuring out that we write one bar ahead and it's out there. Investing is only a struggle if you make it that way. You can make a change right now for one of 2 reasons. First, you can decide you're going to master the markets, then go do it. Or second, you can do it because you've reached a decision point, like millions of investors, where you know you've got to do something, but you're unsure what. Now, either way, my view is you're standing on a threshold, and you've got to break through the fear and uncertainty that paralyzes so many investors right now. Now, I have done a little something about it. I've taken everything I've learned over the past 4 decades in global markets and continue to refine it, perfect it, craft it, and every month I now publish a magazine for individual investors called One Bar Ahead. As in, my hope is you're going to be one bar ahead when you read it. Now, I've created One Bar Ahead to give those who have no idea where to start a path forward and the discipline needed to take it, as well as for those who are busy, confused, or just downright scared. Being one bar ahead combines three ultra powerful proven concepts that I think you're going to want to pay attention to. Number one, the time tested approach of investing in optimism while others cower in fear. Number two, the discipline of buy low, sell high that comes from constantly rebalancing your portfolio to harness the risk others fear and which knocks them off course. And number three, a deliberate focus on the world's best companies, something you hear me talk about frequently on TV and at seminars around the world. Buy the best, ignore the rest. Now, One Bar Ahead, when you're doing it right, offers three things that many investors crave right now. A systematic, disciplined approach that helps people avoid the impulsiveness that trips so many up. B, lower portfolio volatility over time, meaning you get a smoother ride. And C, my favorite part, better long-term investment performance potential over time. All right? To be clear, One Bar Ahead is not for cherry pickers, ticker tourists, or the quick buck artists. So if that's what you're after, please do not sign up. You will not be happy. But if you're frustrated and tired of fighting for Wall Street's table scraps, frustrated by bad advice and false promises, you might find One Bar Ahead to be a great fit. Many OBAers to that end have been reading along with my research for decades, and that doesn't happen by accident. I would love to welcome you on board too if that's of interest. All right, today's bottom line, every single morning you have two choices, people. You can sleep with your dreams or you can get up and make them happen. You got this, I promise. As always, let's make it a great day and finish the week strong. See you next time on Monday. Cheers.